Namaste friends, welcome to GyanVeda channel. In today's video we are going to discuss on an important topic, how much income tax one needs to pay on their mutual fund returns over the long term or short term basis. So please watch the video till end so you will get the complete details. Anyone visited the channel for the first time, please subscribe, like, share with your friends so everyone will get the required knowledge, and don't forget to press the bell icon so you will get notifications for our new videos. During your investment journey, you may incur some loss, some capital gains, and how much the tax you will be paying on the equity, debt. If suppose you are invested in a hybrid fund or the balanced funds, how the LTCG or STCG will get calculated, how much tax you will need to pay, and how much tax you can save in the long term. So please watch the video till end so you will get complete details. When you redeem any units from your mutual fund or if you sell your stocks, then only you will need to pay tax on this one. So till the time you hold the stocks or mutual fund units, you don't need to pay any tax in India as of now. How your gain will be calculated roughly, whatever price you sell and whatever was your purchase price, the difference will be calculated as a gain simply. In mutual fund term, you can say that whatever units you have sold today, so today's NAV minus the number of units into the NAV when you bought these ones, that will be taken as your mutual fund gain. So we will see that how this capital gain is considered actually during the tax calculation. So let's say what is the STCG or short-term capital gain. It depends on the tenure of your investment and it is not same for equity and debt. Let's say if you invested in equity, if you redeemed it within 12 months, you will incur the short-term capital gain. And in terms of debt, this period is for 36 months. And what is long-term capital gain? This is also depends on the tenure. In terms of equity investment, if it is greater than 12 months or 1 year, it is considered as long-term capital gain. In terms of debts, if it is greater than 3 years or 36 months, that is considered as long-term capital gain. In terms of equity, let us say how the short-term capital gain is calculated for your investment for less than 12 months. So you will need to pay a tax of 15% on your gain. In addition, there will be a cess. As of now, the cess percentage is 4% based on the tax amount, not on the entire gain. So roughly it should come around 15.6 as of now, and there is no exemption in this gain. So when you come to long-term capital gain for equity, so that will incur when your investment is more than 12 months. In this case, the tax is reduced to 10%. In addition, you will have to pay some cess on this one. So roughly it should come at 10.4%, I believe. And then there is some clause to get an exemption. If suppose your long-term capital gain is less than 1 lakh, you don't need to pay any tax. You will need to pay tax only on the amount which is greater than this 1 lakh. So just a summary, you can see here together, short-term capital gain on equity is 15% plus cess and long-term equity gain will be the 10% plus cess, but there is an exemption clause of the 1 lakh rupees. Now when there is a debt investment, so what will be the tax you will pay on your short-term gain and long-term gain? So for STCG, which is less than 36 months, you will need to pay tax as per your income tax slabs, plus there will be additional applicable cess. So there is no exemption on this one. So remember that if suppose your income is very low, you may or may not need to pay a tax on your debt investment because it is as per your income tax slab. What happens when your investment is greater than 36 months? In that case, you will incur a debt LTCG. So what happens in this period? You need to pay 20% tax. This is a flat. So this doesn't depend on your income tax slab. So here also says as applicable you need to pay. There is one benefit in this one. you need to pay 20% tax after indexation. So we'll get to know what is indexation actually. So before that, let's see a summary. Less than 36 months, less than or equal to 36 months, it will depends on your income tax slab for your debt investment. And for long-term capital gain, it will be 20% after indexation. So let's make it simple with an example. What is indexation? Keep in mind, indexation concept is not applicable on your equity investment or not applicable on your equity capital gain. So this is dependent on certain factor. It is called as cost inflation index, or in short we can call it as CII. So in this case, it doesn't consider your debt purchase on the purchase date. Suppose you bought something at 100 rupees 10 years back, the purchase cost will not be considered during the tax calculation or the capital gain. Instead, it is called as indexed cost. How the index cost is calculated? There is a simple formula. If suppose you have purchased at certain price into what is the index price, that CII index price when you sold these units, divided by the index price when you purchased it. You will get some advantage only in this one. How we will get? Before that, let's understand what is the CII calculated, how this is structured. We have taken example of last few years. If you want to have the CII values before that, you can visit the income tax portal and get these values. So we have just taken last 10-12 years values. So you can see every year this value is going to increase with certain factor. Now how this will help to save tax? So let us see. As an example, let's say you have invested 1 lakh rupee in financial year 2010-11 and you have redeemed it in 2020 and 21. Let's say your amount became double in this 10 years. So your actual profit is showing as 1 lakh rupee. So do you need to pay tax on complete 1 lakh rupee? So answer is no, because we have some indexation benefit for debt funds. So in this one, how this income tax department allow you to calculate the indexed cost. So indexed cost will come to around 1,80,000 and 239 rupees based on the formula. You can see here the formula which we used earlier as well. So long-term capital gain will be considered as 19,761 as a difference between 2 lakhs and 1,80,000 to 39. Out of that you will pay the 20% as tax, and there could be some cess applicable. Ultimately you are going to save around 16,048 rupees. So you can see there is always benefit for long-term investors. And now we'll see how you can save the tax on long-term capital gain. So in equity, you don't have to pay a tax for first 1 lakh rupees. Then you can opt for selling some shares and then reinvesting. So we'll get to know about this one in our next video. So you can redeem some mutual fund units and reinvest if possible. And you can take this opportunity to switch to a better funds. So in such a way, you will be able to save much tax on a longer term. What else you need to know? If there is a dividend, how much tax you need to pay? There is TDS or not? If TDS is deducted, how much TDS will be deducted? How can you choose a ITR filing when you have a capital gain? And how you can save more and more tax on this one. So please be with channel. We'll bring many such videos for you. If you have any specific questions, you can mention in the comment box. So we will be able to give you answers for your questions specifically, and it will make your investing happy. Namaste. Dhanyavad.